Okay, guys, hi. Just double checking with um okay, guys, we're going to go through the disclaimer and then get this thing kicked off. So this presentation or webinar is provided solely as a courtesy to aid the education of our customers and prospective customers. It will discuss risk management concepts, strategies, and does not include the recommendation or endorsement of any particular security, chart pattern, or investment strategy by forays.com. This presentation has been prepared without regard to the specific investment objectives, financial situation, and needs of any particular recipient, and we don't guarantee or verify the accuracy of the information or commentary provided. Futures, options on futures, foreign exchange, and other leveraged products, they involve substantial risk of loss and are not suitable for all investors. Spot gold and silver contracts are not subject to regulation under the US Commodities Exchange Act. Contracts for difference, otherwise known as CFDs, are not available for US residents due to regulatory reasons. You can't see a disclaimer. Okay, cool. Let me just double check. Bloomberg charts. My own charting system, unfortunately, isn't able to work at the moment, probably won't for the next couple of months. But this one is Bloomberg. Prices aren't necessarily the same as those offered by forex.com, but they are pretty close. So let's look at the euro. Now, the euro is stealing a little bit of the limelight. There's a few things stealing the limelight, actually, because the main theme impacting asset markets, I think, on Monday is growing expectations that the ECB is going to be preparing to take further action and basically replace the Fed, stand more alongside the Bank of Japan, providing ample liquidity through QE. European stock markets, they are higher. But I have to say it's not been broad based. But the DAX, for example, had a fantastic start. The S&P 500 had a fantastic day yesterday as well, and that was despite some weaker German data actually. So it seems like bad news is fairly good news for equity markets once again, as the ECB is about to embark on QE. Now, whether or not we do get QE, I think will depend on Thursday, on the 29th, data from the 29th, which, let me just find the exact date for you, is going to be Friday morning. We're going to get inflation data for August out of the Eurozone. That's expected to fall to 0.3% from 0.4%, lowest ever level, massively, suggests that we are on the cusp of deflation, actually getting closer to it. So people will have said, 0.5% is terrible, 0.4% terrible. Let me tell you, 0.3% is really bad, particularly if that causes the ECB staff forecasts, which are going to be released at next week's ECB meeting, to suggest that there is a real risk of deflation. If that happens, I think it's going to be a nail in the coffin. There is going to be QE. We're going to see another leg lower in euro and potentially another leg higher in stocks, because that's how all this QE business works. QE, why the ECB will embark on it is because they want to weaken the currency, right? QE does tend to do that. It has a fairly good history of doing that. Look at the US dollar, which we'll look at shortly. On the other hand, though, it can also be very good news for stock markets. Markets love liquidity. They love the hopes and dreams that are included in QE of a better economic future, and so that's going to be there. Now, also adding, so as you can see here, euro, if I could just go on a very day, we're actually a little bit mixed. But if I go back, say 5 days, as you can see, there's been a torrential line of abuse. So even though today we're managing to hover around about that 132 level, we're really trading in a very tight range after quite a sharp decline. We've fallen nearly 5% over the last couple of months. So, euro definitely in the doldrums. Where could go to next? Well, I'm just going to have to just lengthen this chart a little bit. Oh, what's happened here? Goodness. Sorry, guys. In terms of a few levels for you, we've got this low here for large level, and you're like, we'll do whatever it takes to save the Eurozone. Up until May, we were in a bull trend on the back of that. Now the market wants some action, right? Now that inflation is falling off a cliff, we want some action. And that break below 132.30 on Friday, which was a 61.8% retracement of that July 2013 to May 2014. That wasn't, the July 2013. That wasn't the druggy. We save everything. But it was, this is quite a key level that people are looking at. The break below there was a very bearish development, and suggests that there could be further extension to the downside. We're looking at 131.05, which is the lowest level since September 2013, 6th of September 2013. And then below there, we'd also look potentially for a move back towards 130. So, you know, right now we are looking very, very bearish. Now, as I've said, and I know if you follow my colleague Fawad's, he's off at the moment, but he should be back next week. If you follow his research, he does a lot around Fibonacci. So looking at Fibonacci here, basically how it works. Essentially, yes, it's price patterns. The different retracement levels are more important than others. 38.2 is a really important one. 61.8 is really important as well. So 61.8 really just solidifies. If you get break below there, it solidifies that downtrend. It suggests that momentum is definitely still on the downside. There could be further downside to go, and that's what we saw on Friday. And that's why I think the market is just being a little hesitant. I think if there is any upside in euro, I think it's going to be quite limited because obviously they've got this huge elephant in the room of, is there going to be QE? And we know that QE can weigh very heavily on a currency, so that's worth watching. Added to that, I mean, we're well below its key levels. Even if I remove this, let me just sorry guys, we just remove this one, because you can also do an even deeper retracement from when Draghi said we'll do whatever it takes to save the euro. It broke the 38.2% level of that, which came in at 132.56. So the next level there we'd watch is 130.24. Obviously, that is the 50% retracement of that entire uptrend for the latest 2 years of uptrend. There's a retracement there for that as well, which comes in at 130.24. So that's worth watching. There wasn't too much hesitation in moving significantly lower in the euro either, and that's another thing that just adds to our expectation, and that we could see some further momentum to the downside, even after everything we've seen really since May. Just looking at this and what it means to the dollar. Now, when you look at, I know when you first start currencies, I know this can be a bit tricky concept to get your head around. But if, for example, the euro is coming under pressure, yes, one would expect Euro Aussie to weaken as well, but you would probably look for the dollar to do quite well. And the reason why is because of the way that trading is made up. The FX market is a 5 trillion a day market. It's probably, it's huge. It's absolutely enormous. And, 30% of all that trading is done with the dollar on one side of the equation. And the vast bulk of that trading in the dollar is done euro dollar. So the key takeaway from what I'm saying here is to say that if the euro is weak, it probably benefits the dollar. And the reason why is that the dollar the euro is the second most traded currency. If that's weak, people will climb into the euro because they love liquidity. They'll climb into the dollar, because they love liquidity. George, you're saying, do I see euro dollar dropping below 130? I think I do, but that's just a thought at the moment from my mind. From a technical perspective, I definitely see us getting to 130. But 130, we know that euro does hesitate around some big levels. It's hesitated around 130 in the past. We would definitely expect it to do so again, and that would be why I would be a bit hesitant about saying, I expect it at 125 by year end. I'm looking at it from kind of a short term perspective at the moment, because we've got so much event risk coming up, and so much of it depends on what type of QE the ECB is doing. Right now, we don't know that. That's an unknown. So, I would say that the odds are stacked in favor of dropping below 130. However, right now I'm looking at, various levels, and I definitely see I definitely see 131 on the horizon. I definitely see that 130.25, that 50% retracement of that massive 2-year up move. I see those levels as being really, really critical. So I do, George, but I think, in the next couple of weeks anyway, I think we're going to get down to 130. And after that, how we react there will really spell out whether or not we get to kind of 120 even. Okay, so looking at dollar index here, so the dollar index, for those of you who don't know, I'm sure most of you do, but the dollar index is the dollar traded against its biggest trading partners. As you can see, fantastic move higher. Even had a gap opening on Monday, and that was after President Draghi, ECB President Draghi, was talking at Jackson Hole, which is the Central Bankers Conference, and he basically sounded pretty comfortable with the idea of QE. As you can see, we are backing away from these highs. We're getting very significant levels here because, as you can see, we are very close to the highest levels since September 2013. That is what's my euro dollar target by end of 2014? Well, as I said, I mean, it could get down to 127 for end of 2014, but I think it all depends on the ECB. I don't make the annual forecasts. I make quarterly forecasts. And I think, you know, a lot of people would say that our, you know, we've gone below expectations really for this year. But as you can see here, we've got the September highs in the dollar index are really beckoning. They come in at 82.67. Just get the exact level for you. 82.67 from the 5th of September last year. So you know, that's very much on the horizon now. If we can stay around this level, then I think, you know, new pastures beckon. I do think that we would, you know, the dollar is looking a bit extended to the upside. I mean, look at these enormous candlesticks. Let me come off tracker. These enormous candlesticks here. I mean, the move has been abrupt. This tells me it's also been, you know, there's definitely some oomph behind it. The market wants us to go higher here, and that is, you know, fairly significant, I think, suggesting that there's a lot of buying interest in the dollar. Now, of course, there is. If we go back, say, just go back to 2012, you know, we've pretty much, you know, after getting, you know, to a high in 2013, when it looked like the dollar was going to really kind of, you know, let go, it didn't. It just meandered lower. So I think now we'd probably be targeting that those 85 levels, or 84.75 level from the 9th of July 2013. I really think they're going to be on the cards, and the reason why, because the dollar's just making gains across the board. You know, that to me is you know, the key thing to watch, really. I think the dollar, you know, because it's so important, the dollar is, you know, when it starts to move, it really does. A lot of interest goes into it. That's what we're seeing at the moment, and that to me suggests a further extension of the uptrend, which is bad news for euro and bad news for other crosses. Now, look, you know, one of the most important crosses, of course, is also dollar yen. Third most traded was yen, second most traded dollar currency. As you can see, we're hesitating a little bit. We got to a high of, get you that exact level. We got to a high of 104.49. Now, it looks to me like there's a lot of option interest in dollar yen at around 104.5. So 104.50. It seems like sellers seem camped ahead of 104.50 option barriers, and that is at the moment discouraging any breaks higher in dollar yen. Hence that, you know, the fact that we backed away from 104.49. We have traded as low as this level here, around about 103.86-ish. We're trading around there now. There could be further upside, I think. You know, we certainly wouldn't be I think that we will get there, but with dollar yen, you often see a lot of options around those whole numbers or those half numbers, and that is because of lots of exporters, right? So, you know, huge exporting nation like Japan. A lot of people are, you know, buying and selling. So there's options matter for dollar yen. So at 104.50, we've got this huge barrier level. That's a massive level of resistance. Etch it into your mind if you're trading dollar yen, because we would expect that to just trigger a bit of pausing for breath, I would say, and it may just on stickers for a little while. Yeah, I do think that probably, you know, looking at 103.50 should act as very good support. As you can see, it held. Let me zoom in. As you can see, it held here. When was that? Back on 22nd of August. And it could easily, you know, we don't see any reason why it wouldn't at the moment. There is some economic data out later today. There is S&P Case Shiller house price data. There's also durable goods. Durable goods could be very, very high, but that could be due to this quirk due to airlines. and then the S&P Case-Shiller house price index looks like it's rolling over. So that's another thing to point out there. Right, let's also look. So even though the euro is under pressure, it wasn't the weakest currency, actually. The Kiwi was. Kiwi sentiment has really, really fallen dramatically. As you can see, we broke so easily below the 200-day moving average last week, and we've just continued to extend declines. Sentiment's turned quite sour. It's only really managing some dead cat bounces, as you can see. But to me, it looks like, we're in, a series of lower lows. Is a downtrend. That's what a downtrend is. So I wouldn't be surprised if we continue to see, some further declines. But just looking here over the last 12 months, some key levels to watch out for, guys. From that low from September last year to the high that we saw. Do you remember those highs in July? We're now fast approaching that 5% retracement of that move at 82.79, so around about 82.80. If you get below there, then it opens the way to 81.47. So that'd be the lowest level since early Feb. So that's a key thing to watch out for as well. I do think overall that the QE is just lost its shine. It looks like a lot of the interest rate hikes have already been priced in. Doesn't look like there's going to be that many more of them. And for me, that is probably a real sign that the market's falling out of love with Kiwi and fast. It's also falling out of love with the euro, and it's starting to find a bit more interest in the dollar. So they're the main themes. And I think, in FX, there tends to be one or two themes that dominate the markets. And I think stronger dollar, weak Kiwi, weak euro, they're the themes for now. If the US doesn't raise interest rates, what's the reasoning to short the Kiwi? Well, it's not about actual raising interest rates, George. It's about the expectation of it. So they don't even have to raise interest rates. If they suggest that they may be moving even a pigeon step closer to raising interest rates, that can be enough for the markets. Trust me, they will go pricing that in. Even though New Zealand does have a better interest in carry, it's been on an uptrend already. There's a lot of pent-up demand for the dollar. People have been expecting this move higher for a while. So that's why I think people would favour the dollar over the Kiwi. But I think you ask a very good, very logical question. And sometimes the FX market, unfortunately, doesn't work as logically as we do. Now, the other thing I want to mention to you is the S&P 500. Obviously, the reason why is because we made a record high yesterday above 2,000, got to the mythical 2,000 level. Now we're not moving higher. We're not open yet. If I look at the futures market, take a quick look at the FX futures, the index futures. As you can see, yeah, so pretty much unchanged. But the high yesterday, or the record high, as we've seen, the record high that we've seen was 2001. If we continue to, if we get a daily close back above that level today, maybe tomorrow, that would suggest that we could actually see a bit of this could be the start of another leg higher. Now, one thing I do want you to watch out for is that as that's moved higher, so as the price has moved higher, volume, which is this kind of histogram down here, has moved lower. And that suggests, obviously yesterday the Europe wasn't in, or UK anyway wasn't in. And when that happens, you get very, very low liquidity. And so that can cause, some outsized moves. And I'm not saying the move yesterday was big in terms of, number of points, but it obviously took us above that key level. So just watch today. Before we can embark on another leg higher, we would look for confirmation by another maybe by hopefully a daily close above 2,000. That's what we would really want. That's what the market's really looking for. But, right now, we're in between earnings season. There are some more earnings to come, but they're really dribbling out. We had a decent enough earnings season, I suppose you could argue. We've had decent enough economic data. We've got some economic data coming out today. And then equally, you've got the ECB embarking on QE. So even though it's not the Federal Reserve, even though we've got the Federal Reserve, scaling back on its QE, tapering will end in October. The Fed's going to be quite careful. It's going to tread quite carefully, and then you also get this extra liquidity from the eurozone. So if banks or investors or whatever, we do know with QE that money liquidity seeps out of the economy it's intended for. It's slipped out of the US when the Fed were going at it, and it could do so in the eurozone too. So just watch that. As I said, 2001 is the key level to watch for. Probably get above, the good old 2010 mark to get the bulls interested. A daily close above there today, though, with above 2000 at all today would be a very bullish development. So the other thing that I would point out as well, as you can see, we've had some disparate moves, I would argue, but overall, the S&P, that's a nice uptrend. You can see that yourselves. Yes, the ranges are quite small. I'd keep your ranges narrow if you're trading stocks. But overall, I think that the S&P, there doesn't seem to be anything in its way so far. It's managed to rally all through August, all through the geopolitical risk that we've seen.